In January 2026, the silver market reached a height that seemed impossible just a year prior, $121 an ounce. Then the market turned. The price plummeted 40% in a matter of days, wiping out billions in retail wealth and leaving investors in shock. Financial headlines are already calling this the end of the precious metals run, advising anyone left in the trade to sell before the floor drops even further. But the crash on your screen masks a diverging reality. While the paper price falls, the physical supply is draining at a rate that is starting to alarm exchange analysts. To understand why this disconnect exists and how to navigate it, we need to look at a specific three-step cycle currently playing out in the global vaults. Following the digital ticker right now could lead you to exit a position just as the physical supply chain reaches its breaking point. This price drop is a direct result of the mechanics inside commodity trading pits like this one. When the CME Group raised margin requirements, it forced traders to put up significantly more cash to hold their silver contracts. Those who couldn't pay were hit with mandatory liquidations, triggering a cascade of sell orders that drove the price down. While those paper contracts changed hands, the physical reality was moving the other way. Registered silver inventory at the COMEX fell to just 76 million ounces, meaning the exchange has enough physical metal to cover only 13.4% of the open interest. We are now in the sixth consecutive year of a structural supply deficit. In 2026 alone, the market is short approximately 67 million ounces. This creates the effect of a compressed spring. The more the paper market uses financial leverage to suppress the price, the more force builds up for a physical snapback. How are you adjusting your 2026 portfolio? Let me know in the comments if you're prioritizing the stability of gold or betting on silver's role in the tech sector. The futures market is pricing in a surplus, but the vaults are empty. It is a mathematical contradiction that cannot be sustained indefinitely. This is the inelastic supply trap. Because 70% of silver is produced as a byproduct of mining copper and zinc, miners cannot simply ramp up silver production just because the price of silver is rising. This rigid supply is meeting a surge in demand from AI infrastructure. These data centers rely on silver's conductivity for everything from high-performance chips to advanced cooling systems. As the shortage intensifies, AI firms and EV manufacturers are moving away from just-in-time logistics. They are now hoarding physical inventory to ensure their production lines don't go dark. By pulling physical bars directly off the exchanges for their own internal reserves, these industrial giants are shrinking the amount of metal available for the rest of the market. Silver's role as an industrial material has turned it into an essential technological component, one that is currently being depleted faster than it can be replaced. Institutional investors are currently staying on the sidelines, preferring the guaranteed yields of fixed-income bonds under the current Federal Reserve policy. Silver manufacturers are also feeling the squeeze. They are spending millions on thrifting, researching ways to replace silver with copper to lower costs as prices climb. This period of institutional caution and industrial thrifting is creating a brief window of accumulation for those watching the physical inventory levels. While some point to the speculative Hunt Brothers spike of 1980 or the 2011 crash as warnings, those events were driven by finance. Today's demand is anchored in the literal manufacturing requirements of the AI and EV industries. To survive this volatility, you have to separate the daily movement of the paper ticker from the physical constraints of the global supply chain. Eventually, industrial users will reach a point where they must pay any price to keep their factories running. When that happens, paper short sellers will be forced to buy back their positions in a market with very little physical metal left to sell. When you recognize the physical desperation building behind the scenes, a $70 paper price looks less like a popped bubble and more like a temporary distortion before the supply chain forces a major repricing.